I'm Anthony Valeri, Director of Investment Management at Zions Bank Corporation. Thank you for joining us and our quarterly economic and financial market outlook webinar. Today, we'll cover the economy, look at stock and bond markets, finish with a review of some AI-related concepts, food for thought, and then Q&A at the very end. So why don't we go ahead and get right into our presentation for the April Market Outlook webinar. Let's start with the economy, and the labor market is still strong. In fact, accelerated to start 2024. This is monthly payroll data. And you can see on the far right how the monthly payroll for January, February, and March was successively stronger than anticipated versus prior months, with the 3-month average also trending higher. So when you look at payrolls, really reflects well on the state of the economy, and that robust labor market has been a key driver of consumer spending, which in turn has fueled continued economic growth. When you look at the consumer itself, after a slow start to 2024, consumer spending has picked up. Here we look at retail sales, excluding autos and gas. This is the year-over-year percentage change. Again, slow start in January, but a really strong print in March that showed that the consumer continues to do their part and it's spending to power the economy forward. Today's first quarter GDP print, which was the first release of first quarter economic growth, was weaker than expected, coming in at 1.6%. Much of that due, however, to the due to exports, which were weak, and also a decline in inventories. But when you strip out consumer spending, it was actually 3.1%. Those are real final sales when you exclude the inventory and trade components. That's a fairly strong print and continues to show that the consumer is healthy and driving the economy. So demand still healthy. And when you look at the manufacturing sector in the US, this was a soft point in 2023, actually starting in late 2022. And manufacturing has rebounded in the US. So out of its soft spot, manufacturing recovering and now is in expansionary territory. This is the ISM manufacturing and service survey indices. A reading above 50 indicates expansion, below 50 indicates contraction. When you get below 45, that's indicative of a recession. And you can see the blue line dipping in 2023, indicating a slowdown and a contraction. That has reversed in recent months and also speaks well to the strength of the economy and manufacturing exiting a soft patch. There is an impact from Fed rate hikes. However, the economy isn't just blazing along on all cylinders. There are some pockets of weakness. One is the small businesses. This is the National Federation of Independent Businesses showing both job openings and hiring plans, both of which have dropped off in recent months. In fact, the last print was particularly weak, with hiring plans now at their weakest since just after the pandemic. In terms of job openings, the lowest since May 2020. This part of the market, smaller companies are more sensitive to higher interest rates. They tend to be a little more leveraged. So we are seeing a negative impact here. For those of you that did join our market outlook, you know that we talked about auto delinquencies, credit card delinquencies. Those two remain elevated relative to history. So there are parts of the economy that are certainly impacted by what the Fed has done in their aggressive rate hike campaign. But when you look at financial conditions, and it's trying to capture just how the economy is powered ahead, financial conditions measure the friendliness of financial markets. The narrower, the better the stock market does, the narrower credit spreads are. That is a conducive, or the more positive these are, the more conducive to economic growth. And this index tracks whether those metrics are positive or negative. And when it's negative, it's a detractor to economic growth. Conversely, when it's higher, it's a positive for growth. And you can see that even after an aggressive rate hike campaign from the Federal Reserve, where they raised rates by 5.25 percentage points from March 2022 through July 2023, we have easier financial conditions now than during the period of rate hikes. And what that is basically telling you is there are parts of the economy that haven't really felt the impact. Part of that is due to low fixed rate debts. I'm sure many of you are aware that the majority of fixed rate mortgages are 4% or lower. Corporations have locked in low financing as well, and therefore less sensitive to those changes in rates. So there's a good chunk of the economy that really hasn't borne the full impact of those rate hikes, and that has helped power the economy forward. So despite today's weaker than expected economic GDP print, really the underlying details of that report speak well to the economy, but it also speaks to the fact that we have a lingering inflation issue. Further improvement in overall CPI may be limited. Inflation embedded within the GDP report was higher than expected. The CPI, probably the most widely followed inflation index, consumer price index, surprised higher at a 3.5% annualized rate for the month of March. And if we highlight the 0.3 monthly increase here in the middle, the 6-month average, which has been 0.3, you see that CPI inflation really won't see much more of a decline. In fact, it actually may increase a little bit over the coming months. And the reason for that is the year-over-year comparisons become more difficult after inflation has slowly declined throughout 2023. This is overall CPI, so I should highlight that this is being boosted by higher energy prices, higher gas, higher oil prices. We also had some one-off impacts in the transportation rather, with auto insurance spiking for the month of March. So we do think that overall CPI will be more challenging. This could be a headwind for further rate cuts and for equity markets. But on a positive note, the Fed is looking at core, and we see core CPI coming lower as we do the other core metrics of which the Fed is more closely focused on. And we think this news is already factored into future Fed rates, as well as the bond market, as well as current pricing in the bond markets and where bond yields are. Nonetheless, that's creating a bit of a concern over the fact that is another inflation cycle underway? Are we going to see another wave of inflation like we did in the 70s through the early 80s? You can see the close match here in the current starting when we match up with 2018. We do not think we're in a repeat of another inflation cycle. Much different environment today. In the 70s, we had what's called cost push inflation, where energy was a much bigger player or role in the economy, and the economy is certainly much more sensitive to energy prices, oil prices, gas prices. That's not the case today. The case today is more of a demand pull inflation cycle, and we ultimately think consumer spending will moderate, and because partly due to the fact that consumer savings are slowly from the pandemic are slowly depleting. It doesn't necessarily indicate a recession, but it does indicate some moderation in inflation. And if we take another closer look on why we think inflation will still come down, the core metrics will come down, is because housing inflation, called owner's equivalent rent within the CPI, is a lagging indicator. It is still decelerating, and we expect that. You can see that on the right-hand side of this chart. You can see how housing inflation is elevated, but still falling, and that should exert downward pressure on core CPI, which is the gold line, even if overall CPI moves sideways. So we do see that metric leading to lower core metrics of inflation. And just to give you some other data points, when you look at all of the metrics that are calculated in the inflation data, a growing number, 42% according to Bloomberg, are showing deflation, and that share continues to rise month over month. So we don't think we're on our way to a resurgence in inflation. That yes, we will see a slower pace of decline, but we don't see inflation resurging or creating another wave. So we do think that that slowdown in inflation will open the door to the Fed lowering rates later this year, once or twice, and likely continuing to cut rates into 2025. So we don't think inflation is going to be a long-term problematic issue for the markets. It continues to create volatility near term. All right, let's transition to financial markets. And the first quarter was a good one for investors, but once again, domestic large cap equities led the way. And this similar theme to what we saw in 2023. Here we show first quarter 2024 investment performance. You can see, again, large caps led the way. The equal weight, which I'll get to in a moment, lagged. If that's putting all companies on equal footing. International also lagged, as did small cap and emerging market equities. And the bond market lagged with a slight decline after a strong fourth quarter of 2023. What this tells you is that a diversified portfolio or diversification generally didn't work well for investors over the first quarter, even if most categories were up. And that's, you have to have a long-term view. It was a good quarter generally for investors, particularly stock market investors, but diversification not adding its full benefit during the first quarter of 2024. And in keeping with themes from the broader markets, what we saw in 2023 repeated to some degree in 2024. We did see pockets of the market broadening in the fourth quarter of 2023 and for parts of 2024, but still it is a story of the Magnificent Seven: Tesla, Facebook, Amazon, Nvidia, Microsoft, Google, and Apple, all leading the broad market and pulling the broad index, the S&P 500, higher. This is all going back all the way to 2023. The equal weights, the gold line, that's still a good total return over that horizon, but you can see that there is a big gap between those 7 stocks and the rest of the market as measured by the S&P 500 equal weight. So a concentration still exists in the equity market. You can see on the far right-hand side of this chart that is slowly starting to turn. In fact, the Mag 7 might even only be the Mag 4 or Mag 5 right now, definitely losing some momentum. And I should add, here in April, this has reversed. The S&P equal weight has come back relative to the market cap weighted index. And here we show that. We use this in our outlook chart showing that the gap between the S&P 500 market index versus the S&P 500 equal weight in 2023 was the largest since 1998. And on the far right, you see that essentially that magnitude of disparity continued for the first quarter of 2024, and almost 3 percentage points difference between those two indices. Again, we think this reverses, and you'll also look at this chart and see that this runs both ways. The equal weight can outperform the market cap weight by a significant margin as well, and it varies throughout history. So we maintain a diversified portfolio. We think that concentration reverses, and we've certainly seen that so far during the month of April, which is a different story. Let's move to valuations, and you're looking at PE ratios. Here's the forward PE ratio of the S&P 500 equal weight, which is the dark blue line, and then the gold line is the market cap weighted index, and they are still higher. They indicate an expensive equity market relative to history. The key here is that these valuations didn't change a lot in the first quarter, and the primary reason is that corporate earnings were fairly strong. So as prices increased, earnings went along with that, and the PE ratio wasn't much changed. What this tells us is not necessarily to abandon stocks, but rather expect lower returns going forward. In fact, that's what our forecasts are calling for, mid to high single digits for stocks here. We do expect a slowdown in performance. But it's important to note the positives driving the equity market, and that is those earnings. So we had a decline in earnings late 2022 into 2023. This is annualized earnings growth for the S&P 500 index. We show the estimate, which is the blue bars at the start of earnings season versus what was ultimately reported. And you can see for the last 3 quarters, a fairly strong beat relative to consensus, even in a decline in the second quarter of 2023. It was a notable difference between how earnings beat at the start of earnings season's forecast, and earnings growth over the third and fourth quarters of 2023 still strong, 8% and then 10% respectively. If that pace continues, not hard to envision earnings being potentially double digits for 2024. So that would be a good underlying positive for equities. They still are a good underlying positive for the equity market. First quarter 2024 earnings season is just underway. A little less than 20% of companies have reported. We'll know more in 2 weeks how the growth rate is shaping up, but so far the preliminary growth rate tracking to 6%. But this positive earnings growth, again, a key for equity markets going forward. Now, the common complaint we often receive from not a complaint per se, but a fear, is that the stock market is going to retract, maybe decline quickly because of recent strength, and not just the first quarter of 2024, but we're talking late 2023 as well, seeing such a strong run of performance. What this chart shows you is that momentum is a powerful force in the stock market. And it's important to be aware of it. And when the market makes an all-time high for the first time in over 2 years, forward performance across 3, 6, and 12-month periods is very strong. And it's actually better than all periods when all-time highs are recorded. And this is not to say a forecast from us that stocks are going to be up 13% over the next 12 months. We don't think that. Again, we're looking for a mid to high single-digit total return. But any case for capitulation, we think, is misguided. It is normal to have pullbacks, but when you have this type of momentum, it bodes well for future performance. And there's other ways to look at it. Since 1950, when the first 3 months of the year were successively higher, that's January, February, March, stocks usually finish the entire year higher. That's happened 19 of the past 20 times that's happened, with average returns above the historical average. And when stocks close higher for 4 consecutive months, they did at the end of March and February, subsequent 12 months gains are also above average. And then a 5-month win streak at the end of March also bodes well for future subsequent 12-month performance with above average positive outcomes. So there's a number of metrics, a number of ways you can look at that. All of them tell you the same outcome, and that momentum is certainly a powerful factor. And just because markets have been strong doesn't mean we're going to see an extended bear market, or because for a bear market going forward. With that said, the month of April is a reminder that volatility is normal. Here we look at calendar year returns for the S&P 500 back to 1990 and show that the blue bars 75% of the time, which is in line with the longer term averages, the stock market finishes higher. The red dots represent the maximum intra-year decline, in other words, the peak to trough decline for any given calendar year. And then the gold line represents the average decline, which is 14%. So remarkable to think that 75% of the time, stock market will finish a given calendar year higher, but during that year, you'll suffer through a 14% decline on average. So it is normal to have a decline in an upward trending market, a key reminder as April unfolds. Also keep in mind that a 5% pullback happens multiple times a year, on average 3 times per year. The current peak to trough in April is actually 5.5%, rounded to 6 there on the far right-hand side of that chart, with the year-to-date S&P 500 up just over 5%. So a reminder that volatility is normal, not a cause to abandon a diversified investment plan. Let's move to bonds, and the key driver has been a big change in what the Fed is expected to do to the overnight rate. Here we show the futures implied Fed funds rate at the start of 2024 versus where it ended, where it priced on April 10th. You can see a big change moving higher, with essentially the market saying we're looking at 1 to 2 rate cuts for all of 2024. That's down from about 6 at the start of the year. A remarkable change, and the blue bar shows you that the December FOMC meeting date, now that rate expectation is essentially priced out over 1 percentage point worth of rate cuts, as you see on the right-hand side of this chart. So a big shift in rate hike expectations over the first quarter. This is historically rare to see this kind of movement over such a 3-month span. So when we talk about bonds, know that this has been the key driver. This is unlikely to repeat. I think that Fed rate cut expectations, or future Fed policy rates, are fair, even though we do expect 1 to 2 rate cuts. I think that is correct, and the bond market has already adjusted to this. So we have a neutral view on bonds. And as we look at what happened to the bond market in the first quarter, those shifting Fed rate hike expectations moved both the 2- and 10-year Treasury yields higher. That in turn pressured high-quality bond prices lower. And so you can see the move here, a fairly substantial move higher in Treasury yields over the first quarter. The big difference from 2022, and we don't believe more rate hikes are coming, is now becoming a fear in the market. That 5% level for the 2-year treasuries brought about some buying interest. That 2-year treasury yield has hit that level 3 times here in April, and we're starting to see more demand come at that level. And we think ultimately more investors will take advantage of these higher yields. Again, we remain neutral. Locking in these higher yields has been a benefit to the price volatility of the first quarter. Those higher interest rates now providing a greater buffer. And when we look at the best or true valuation of bonds, we look at the real or inflation adjusted yield. And if you look at the 10-year treasury inflation protected yield, which is a real yield, you'll see that that has increased above 2. It's nearing the peak we saw late 2023. Outside of that, this is the highest we've seen this real yield in the past 15 years. So it's a sign of better value in the bond market. This could go higher, and the biggest risk perhaps to treasuries is to see how this supply, record supply, is being digested. The market is managing. There's been some weak demand at various auctions. Historically, supply has not been a primary driver of bond yields. So keep that in mind. It could lead to volatility, but again, historically not a key driver. That is a risk that investors could demand a higher real yield if there is a lot of debt that needs to be taken down in the market. But again, we think there's fair value here in the bond market. Had this real yield been up around 3 or 4, we would argue for a more aggressive posture in bonds in terms of longer maturities. But that's not the case, and will remain neutral in terms of interest rate exposure. Where we are focusing is in the high quality market. When you look at corporate bond valuations, this is the average yield advantage or spread of an investment grade corporate bond relative to comparable treasuries. That gap continued to shrink in the first quarter of 2024. You can see it's below average and under 1% for investment grade corporates. And a similar story in the high yield bond market. The average high yield spread dropped as well in the first quarter. So corporate bonds, both investment grade and high yield, got more expensive and further away from their historical averages. In high yield, that spread actually dropped below 3%. So we don't feel we're adequately compensated in the high yield bond market. We'd rather take that risk in the equity market. So we maintain a high quality bond exposure. And finally, on thematic point, I'd like to leave you on, beware the investment hype. And I mentioned this specifically to artificial intelligence and AI, which continues to dominate the headlines. Remember, we're not far removed from when the world thought stay-at-home beneficiaries like Zoom or Peloton would be the next great investment. And certainly they surged, but as you can see here in this chart, that those prices came crashing back down to earth. As it took more than a year. It took a few years for this to happen, but a reminder that some of these trends can certainly change. What I find remarkable is a COVID leader, Pfizer, and I don't think this is a hype per se, but to think that Pfizer's stock price now is below where it was just prior to the pandemic, or even at the pandemic low, is just a remarkable change of events. This is impossible to predict, and it speaks to having a balanced, well-diversified investment portfolio. And then when we move to electric vehicles, also beware the hype there. Another popular area here, we look at Tesla and Rivian, two stocks that many thought would be the new champions of transportation. And electric vehicle adoption has certainly grown, but it didn't meet the lofty expectations that the market placed upon these two companies. And we've seen a gradual unwinding in their stock prices too. So do be careful. And again, a diversified portfolio is the best way to go. Thank you for joining us today. And I'm going to turn it over to Rebecca Robinson, Head of Wealth Management.
All right, thank you, Anthony. And for everyone who has joined, we had some questions that were submitted in advance. You're also welcome to submit questions in the Q&A function. So, Anthony, we're going to start with interest rates because I think it's everyone's favorite topic right now. And just even as this question was submitted a couple weeks ago, we said, do you think there will be 3 rate cuts? Now we just said we don't think there's more than 2 for the year. Could you talk about maybe a little more what we're thinking with rates, but also I think this question comes from what drives some of the decisions around those rate cuts and why does that change so much? Why do we say it's 6 and now it's 2? And if people are sitting on the sidelines waiting for it, how do you think about that?
Yeah, that's a good point. Why they changed so much is partly because the Fed's got it wrong so often in the past, and the market tends to, intimate what they think will happen. And at one point, they thought that inflation, given how much it decelerated in 2023, was going to continue into 2024. That didn't happen, and so expectations adjusted. Near-term investment performance or pricing can really fluctuate a lot based on emotion. I think that's partly what happened here, Rebecca. And now I think there's a much more realistic view of this last mile, so to speak, on inflation is going to be tougher to come by. The Fed's going to be prudent. They are aware of the resurgence in the 70s. They don't want that to happen again, and so are going to be cautious about the timing of the next rate cut.
And I think along those same lines, we know our business owners are looking to look at what's the cost of debt, making choices there. But then a lot of our individuals are also really asking this question in terms of mortgage rates. And this is a topic, when do we think mortgage rates will come down? And so I thought it'd be good to have a discussion about really what the peg is for mortgage rates, why it doesn't necessarily move as quickly, and kind of what we're thinking about, even just mortgage rates. And if you're thinking about buying, how long will you have to wait? Particularly, how long until we see that, sub 3% again?
Yeah, we that comes up a lot. Fed's going to cut rates, therefore mortgage rates are going to come down. Well, not necessarily. Uh, the mortgage rates are based off the 10-year Treasury. They're also based on how the mortgage-backed securities market is doing, which in turn doesn't move one for one with the 10-year Treasury. But 10-year Treasury is probably your best bet if you're looking for an indicator. Even if the Fed cuts rate, it's how the 10-year moves. If the market believes the Fed's being a little early and believes that inflation is going to resurface and grow because the Fed's being too easy, you could see the 10-year yield go higher and mortgage rates go higher in turn. It's our view that inflation will come gradually down. We see enough pricing coming down that we see a modest decline in the 10-year, but not a big one. I think it's going to be a modest decline later in the year, maybe 0.25%, maybe 0.5%. But hard to envision more than that, absent a real slowdown in the economy or something that would suggest not even necessarily a recession, but a pretty dramatic slowdown.
And I think when we think about rates, one of the things I like to think is rates were artificially low for a generation. So even as we think about a mortgage rate coming down, if somebody is waiting for 2 or 3% again, I don't think we see that in any time frame that we could predict, if ever.
No, we don't, and I think the that's partly why I use that table on in future inflation. It's really hard to see the math come to that absent a really dramatic downturn. Although we are seeing deflation on a number of or lower prices on a number of items, it's hard to see it go back to that 2% type level. Maybe it's 3 ultimately using the Fed's preferred measure, which by the way comes out tomorrow. We'll get an update on core PCE. Uh, Again, a different methodology, but it's really hard to see it go back to where it was. Just don't envision that.
Our next question is about a soft landing and basically, are we expecting one? Would you mind explaining to everybody what we mean by a soft landing and then what our expectations are with that?
Yeah, the soft landing's an expectation that the Fed will raise rates, and there's fear that the Fed will go too far, and then a recession ensues. Then there's the elusive soft landing where the Fed hikes and the economy does slow down, but doesn't fall into recession. It's arguable whether that's happened at all in history. Maybe once. In the case I would bring up is 1995, after an aggressive rate hike campaign in 94. The Fed did pull off a soft landing then, but that's probably the only good example. I would say we've had a no landing. The economy's been better than expected for throughout 2023. I don't think today's print on GDP was weak, and therefore I would put it in the no landing camp. But because of all the pandemic stimulus and some of the distortions, we still have, and as I showed in the presentation, there's still some impacts from higher rates, and there could be a lag, and this might impact the economy later this year. I do think we'll see more of an impact then. So I wouldn't rule it out, a chance of a soft landing. I'd put us in the no landing camp right now. But again, much to watch for later this year. It's still a possibility to get that soft landing, but for now, I'd say no landing.
Okay, so let's move on to a little bit more of a personal question from a listener. If we have a large amount of cash to invest, where would you suggest we put it? And with a caveat, we're retired.
You know, And we always start our investment approach with planning. What is the goal of this money? What are you going to plan to use it for in terms of spending? So that is the starting point. But yeah, I mean, the cash is attractive now, but don't expect cash rates to stick around. We do expect the Fed ultimately to lower rates. It pays to have a diversified investment plan. And if you're retired young, you do want stock exposure. That's the best way to beat inflation over time, is to have some equity exposure. So come up with an investment plan. If you're concerned about the markets, do a dollar cost average, put it in gradually over the coming months, but would strongly advocate for putting that money to use, after coming up with an investment plan.
And one of the things we're really focused on within wealth management is longevity. We are seeing people live much, much longer. And traditionally, I think people would start to pare back an asset allocation as they approached retirement or they were in it. And I think we really have to start to look at the potential of living much, much longer. And also, long-term care used to be maybe a 2-year type of undertaking, and now it's pushing 6+ years. So I think what Anthony said is really key. If you're making a personal decision, get with an advisor, build a financial plan, and then let's make sure the investment plan matches that plan, because that answer could be 10 different answers for 10 different people. All right, we are moving to the debt to GDP ratio. And this person says it's very, very concerning to them. How much higher can it get before we see a complete economic collapse?
Yeah, we get that one, Rebecca, every once in a while. I certainly push back on the economic collapse. It's the debt to GDP is not going to cause an economic collapse. What it will cause is a slowdown in potential growth. But in terms of that metric, it has come up. If there's various ways to measure it. If you look at marketable U.S. debt relative to GDP, it's about 120%. The Congressional Budget Office forecasts that to grow very slowly over the next several years, to where you really don't get above 130 until for another 10 years, which unfortunately is beyond the reach of most politicians and their timeline. So this is an issue to watch. If our debt burden grows, if the cost to service that debt grows, which it will, and if there isn't spending cuts to offset that, there could be some negative impacts to the economy. I don't foresee a collapse, but certainly it would restrict economic growth. And I think the best way out of that is to grow your way out of it. The economy has been strong enough lately, even with consistent government spending, to lower the deficit, even if slightly. But that budget deficit is still too large, and more needs to be done to bring that in line.
And along those same lines, let's discuss the impact of federal spending versus the value of the dollar. And how is the dollar impacted globally when we think about federal spending?
Yeah, there's not a strong link there. The two main drivers of the dollar would be the strength of economic growth here in the U.S. and level of interest rates. And because the Fed has begun to push back and saying inflation is still an issue, we're not ready to cut rates, that's actually led to a stronger dollar. In fact, the U.S. dollar is up against the basket of currencies year to date. There was some modest weakness in 2023. Federal spending by itself is more of a secondary or third level type factor that might influence it. The biggest, one of the benefits of U.S. has is that a lot of domestically held debt. So that factor is going to be less impactful even here. That leads to less volatility. Japan, for example, with a debt to GDP, referencing our other question, over 200, they haven't seen a spike in interest rates because they're one of the countries where the vast majority of their debt's held internally. And the U.S., thankfully, on a global basis, has one of the countries with a greater share of domestic purchasers, which makes them less susceptible to foreign runs. So it's not so much federal spending. That's more of a lower level indicator. It's going to be economic growth, level of interest rates. That's going to be a bigger driver. And I should caution, the US dollar is still high relative to history against major currencies. We're outside of the last few years. It's the highest level of dollar since 2000. So I would, some weakness is to be expected. Just don't extrapolate it into losing its status as the reserve currency of the world, which is not going to happen anytime soon.
And Anthony, I think along those same lines, we had a question that was submitted, and part of it is around this national debt and interest rates that you've answered. But there's another piece of it I'd like to touch on, and it's about what do you think about the impact of inflation and the potential for a market crash in the next 5 to 10 years? So this market crash question kind of comes up. I think oftentimes we think even back to 2008, we've seen volatility. Talk a little bit, one, kind of about what that means, and then how we look at it in terms of your investments. How do you think about this potential for a market crash, and what does that look like?
We will have, a part of the reason I brought up that volatility is normal is that there are corrections. They're impossible to time, and that even with those corrections, or even a 2008 sell-off, which saw stocks go down 40%, you're still higher over time. You're still averaging a 10% annualized growth rate on or rate of return on equities. Those things are impossible to time. Stay invested. It's best to ride those out. And being diversified is the best way to manage those risks. Unfortunately, that volatility is very emotionally difficult to take, but it's sort of the price of admission for higher returns over the long term. It is normal to have, as I showed, a 14% intra-year decline. 5% declines happen 2 to 3 times a year. A bear market is very rare. That's 20% or more, is extremely rare outside of a recession. So as long as we don't have a recession, to see a significant 20+% correction is really, really unlikely.
And Anthony, I think it goes without saying, but it's important to reinforce. We don't know we're in a recession generally until it's over. And so the idea of trying to even say, well, a recession might lead to a market decline, it's impossible to time. And talk a little bit about, if you miss just very few days of the market, the impact it has on your return.
Yeah, a great point, Rebecca. Two points to make there. One, by the time a recession is kind of acknowledged, especially by the NBER, it's often over. So if you're waiting for that signal, it'll be too late. Stock markets usually bottom, and there's good data to this, several months before the end of a recession. And again, you never know until after the fact that you're in it. So impossible to time. And really just trying to maintain that balance is key, and not kind of fall into that trap of selling at the wrong time.
Perfect. Well, I think that comes to the end of our questions. We appreciate everybody joining. And as always, you will receive a follow-up. If you have additional questions, if you would like to be contacted by a wealth advisor to further discuss your personal situation, please fill that out. And otherwise, we hope to see you for the next quarter. Thanks so much for joining.
Thank you.